Okay, good morning to everyone. Sorry about last night. I wasn't really chance to send this video, so I'm just making a very fresh video for you guys this morning. And I want to believe we are good with whatever we learned yesterday night. So I said we'll be skipping some things that I'll be sending the videos to you. I already sent a PDF file you can read from, you understand? So here we are going to start from the foundational terminologies. So I made mention that we have the pips, the lot size, the spread, the leverage, the equity, the balance, the free margin, the margin level, the stop loss, the take profit. We have ask price, we have risk price, we have all sort of stuff like that, depending order and everything. So here I want to make an highlight, or I want to really go deeper, regarding those stuffs. So here we'll be starting from the pips, which is the smallest measurable price movement. It is the point in percentage. So when you hear pips, you see this when you check my upper screen here. I'm using a phone because I believe that the majority of people here make use of phones, so I want them to know that it's possible to actually trade using a phone. So you see on the top, at the top of my screen, you can see a sell, you see a buy. You understand? You see a space in between that has 0.05. Here we have 89130.71, 0.90, 0.44 at the sell side. You see, so you see that 0.40, 47, 93. That is what pips means. It is a calculation of price movement. You understand? You see, it's changing, and it's changing like that. So that is a pip. That is a pip. Actually, in synthetic, this thing is really not something big like that. If it was forex, then we can say, okay, we are capitalizing on pips. But in synthetic, we don't really go too deep with pips like that. But that is what pips is. And there's one they call pipette. That pipette is going to have a ratio power. The way you have this 97, 88, 01, 31 changing, then there will be something at the top. You understand? Like ratio power 2 point something or something. That is a pipette. But that aside, we already know what a pips is. Then when it comes to lot size, this is the lot size. You see this 0.05, and I define lot size as the volume or size of the position you are trading. You understand? That is a lot size. So this lot size, let's say the more my risk, the more my profit. The more my risk, the more my loss. That is just how a lot size is. Lot size is the volume or size of the position you are trading. So now I'm going to make an example. You see here, let's say this is 0.05. Okay, let me change this one to 1. So this is on jump, and let me say I'm selling here. I place a sell here. So now if you check my SL, this SL I'm going to explain it to us. I'm risking $722 here, and let's say my TP is just at this place. I'm risking 722 to make $1,296. You see. So now if I change it now to, let's say I change it to 0.5. If I change to 0.5 and I click on, I'm coming, let me close this trade. And I click on this same cell. Are you getting it? I click on this same cell. Oh, no, it's not correct. Let me change the lot size. So yeah, let's say I'm having 0.5. Okay, so I click on sell. The other time it was $720 something for 1,000 plus. So now see my SL now. You see, it has changed to 444. And around this place now, see what I'm making. You see, it's not like what I was making before. I'm making $665 now. If I change it again to, let's say I change it to 0.02 or whatever, I'm coming. Let's say I change it to 0.02. let me just do it this way. Let's say this is my entry point. My entry point is where I want to enter my market from. Entry point, you can know that already, where I'm entering the market from. So let's say this is my entry point, and here I'm risking this $467 to make $851. So now I'm going to change this one to 7. You see, it keeps changing. If I change it to 9, you see, from 600 it moves to 841. You understand? So it goes on and on. So that is a lot size. A lot size is the volume or size of the position you are trading. Are you getting it? And now we'll be moving to spread. So talking about spread is the difference between the bid and the ask price. Let me change this time frame to the lowest time frame, which is let's say the 1 minute. I'm not even getting a very good spread here. Okay, I can see a spread. You see this red and green line that is moving, that is jumping up and down. You see this green and red, the space in between is the difference. So that is the spread. All those things are not really something you really need to rack your head over, but at least you must know what you are doing as a trader. You understand? So we'll be moving to margin. The margin is the 1% of money you put down from your money to participate in a trade alongside the 99% of the money a broker gives to you. I'm going to take that again. A margin is the 1% of money you put down from your money to participate in a trade alongside the 99% of money a broker borrowed you. You know, in the sense that back then, people have been trading, but not people like us, because we don't even have enough money to trade. You get? People like Bill Gates, Dangote, talk about all these rich people, the Elon Musk, Warren Buffett, Donald Trump. All these people are rich traders. You understand? They have been trading for a very long time because trading was based on liquidity provider directly. But since the existence of brokers, people like us have been able to register accounts. We have been able to do a thing or two on the trading side, or in the trading industry. You understand me? So each time you put in, let's say you want to enter a trade now and you are risking $1 on that trade, your broker is giving you a loan of about $99, which is 100. I said margin is 1% of the money you put down to participate in a trade alongside the 99% of money a broker borrowed you. So if you are risking $1, your broker is giving you $99. You might not be seeing it, but they are giving you $99 just to participate, just to be a participant in that particular trade. So that is that about the margin. And you can also divide margin as the capital required to open a position. As simple as that. They borrow the money or not borrow the money is still a capital required to open a position. And we are going to be moving to leverage. These are the foundational terminologies I'm talking about. I've mentioned 4 already, so we'll be moving to leverage. A leverage is a financial tool that allows traders to control a larger position with less capital. I'll take that again. A leverage is a financial tool that allows traders to control a larger position with less capital. And in essence, is the amount of money lent to you by your broker to do business, or execute a contract, execute a trade. And once the trade is over, either in loss or whatever, they pull back their money. And if you check the definition I gave to you the other time about margin, I said it is the 1% from the 99%. Is the 1% while your broker gives you 99%. That is on margin. But on leverage now, it is the amount of money lent to you by your broker to do a business. And once the business is over, when that particular contract is over, they pull back their money. You understand? So that is just what a leverage is. It's as simple as that. And talking about the next one is equity. This is simply this account size. Everything about your account, the profit, the loss, the running ones and everything. Equity is simply your account size. It is the margin plus free margin. We're actually still going to talk about the margin plus free margin. So equity is simply the account size. And talking about balance, balance is the account value excluding open trade. These definitions are even very easy and you can easily grasp even if you are not a trader. Balance is the account value excluding open trades. Excluding, that means open trade is not inclusive. Your current balance, what you have left, you understand? It only updates after a trade is closed. That is for balance. It updates only after a trade is closed. So for free margin, I mentioned that equity is the margin plus free margin. So now for free margin, margin is the amount available to open new trade. You get? Margin is the amount available to open new trade. The amount available, the capital available to open new trade. You can have like $10,000 in your account now and you've opened some trade on some commodities or assets and they are running already, maybe in loss or in profit. Then you want to open a trade, you see that they write not enough money or whatever. So that means that your free margin is not enough to take that particular trade to execute that contract. So your free margin is the amount available to open your trade. This is the amount available to open your trade. Are you getting it? That is equity minus used margin. So I will be talking about margin level. The margin level, a crucial safety metric. If it drops below a certain level, the broker may initiate a margin call or close positions to protect your account. That margin level, let's say you have $10 in your account and you're executing a trade, then the trade is, the trade is going against you. You are in drawdown, it's going against you. So this margin level is a critical safety metric. You understand? It's like a safety precaution. So when it drop below a certain level, the broker itself, I define the broker for us as like a bank, like the First Bank, the Access Bank, while I define MT5 for you as the application of those banks, the application you use just to do some operations in the bank. You don't need to always go to the bank to do things. You can just do it from your phone, you can do it from your system as long as you have the application. So now this margin level, if it drop below some certain point, the broker will initiate a margin call. A margin call means that they will close or they will notify you that your profit and your loss is going really down than the normal. Are you getting me? So position just to protect your account. That's where you hear that I blow my account. A trader will tell you that they blow account. That means the account, there was a margin call on the account. So moving on to stop loss. The stop loss is an automatic order that closes your trade at a specific loss level. You stop a loss. This is just what a stop loss is. I'm coming. Let me do something. You see my screen here? I'm selling here. So yeah, this is my stop loss, SL. SL is stop loss. So now I'm only risking $22. So even if this trade is going to go against me, yeah, it's going to take only $22 from my account. Are you getting me? It's only going to take 20. Okay, let me allow this trade to get $22 off here. I'm coming. So let's say I did not even sell this trade, but let's just hope like, okay, this is what I mean. My SL is there. Let's say I'm selling from here and my SL is just, yeah, my SL is there like that. You see, it has taken $15 away just like that. So this $15 is the amount I'm willing to risk. So SL is the automatic order that close your trade at a specific level, because I've given this platform an order that once it reaches this particular place, close my trade for me. $18, close my trade for me. So that is that on that. Then coming to take profit. Take profit is an automatic order that close a trade at a particular profit level. It's just the opposite of stop loss. Stop loss is closing a trade, automatically closing a trade at a specified loss level. But TP is an automatically closing a trade at a winning level, a profit level. Just like this. If this trade should come here now, if this trade should come to $25 now, it's going to close automatically. You understand? It's an order I've given to the platform already. You get me? So that is what take profit is. And when you talk about entry point, this is an entry point. Let's say I said I have a buy here now. A buy. This is my entry point. Here, this is my entry point. Where this buy is my entry point. This is now, you see, I clicked on sell, and that particular place I clicked on sell is my entry point. The point at which a trade is being executed. It's very, very easy. So, talking about volatility. Volatility refers to how fast or slow price moves. When you hear that a market is volatile, like it's too volatile, you hear that this trade is too volatile, this market is too volatile, they mean that the trade is moving too fast. It's too fast. You understand? So, talking about drawdown is the peak to tough decline in your equity. I think I've defined what equity means to us before. Equity is simply the account size, the margin plus the free margin. So when you hear drawdown is a decline in your equity. When you are losing your equity, you are losing your money. Let me close this trade first. You are losing your money. See, this is $41 already. So just like so, drawdown is a decline in your equity. So that's just what it is. And break even, somebody made mention of break even yesterday. A break even is the point where revenue equal cost and profit and loss equals zero. Break even is when you are not making anything in the trade and you are not losing anything in the trade. This is what I simply mean by break even. This is my entry point now. You understand? This was my initial stop loss. This is my CP. So let's say this trade has gone to a little profit like this, then I can say I move my stop loss to my entry point. You understand? Moving your SL to the entry is simply what break even means. Moving it to the entry. And now when you ask price and bid price, ask price is the price where you will be quoted at when buying an asset. Bid price is the price you will be quoted at while selling an asset. This is it. Let's say we've been doing some kind of trade by barter before. Maybe okay. Let's use football as an example. Madrid wants to sell Cristiano Ronaldo. You understand? So they are asking. Madrid will be asking, let's say, Juventus to bring 200 million euro. You understand? They are asking. You get me? Because it's Juventus that want to buy Cristiano Ronaldo. So the price where you will be quoted at when buying an asset, Juventus wants to buy Cristiano for Madrid. So Madrid is placing an ask price on Cristiano at 200 million euro. So now Juventus will bid because the bid price is the price you will be quoted at while selling an asset. So Juventus will bid that Madrid, we don't have more than 150 million to place on Cristiano. You understand? So the buyer is bidding. The seller is asking you to bring a particular price. I hope you understand that scenario. So moving on, then type of orders. Talking about type of orders. Sorry. We have the market or the instant order. Market/instant order. Everything I've sent it in the PDF I sent this morning to the group. So market/instant order, instant execution. This simply means joining the market at the current price. This is what it means when they say the current price. See this. You see this spread that is moving, this red and this green line that is moving. You can see it's changing from 89128.91, 2583, 2796, 2730, 2570. It's moving like that. So that is the current price of the market. So I just joined at the current price. That is an instantly. I just joined. Pa. You see, I bought from there. I just joined the market instantly from that place. That is an instant execution. So I'm going to close this trade as well. So this is an instant execution. Then we have pending order. When you hear pending, you already know that they are talking about waiting. Something you said and you are waiting for, is pending. A pending transaction. So under the pending order, we have the stop order and we have the limit order. We have the stop order and we have the limit order. So under the stop order, we have the buying stop and the sell stop. I'm going to explain all these things to us. We have the sell stop and the buy stop under the stop order. So now the definition of a buy stop: the order placed above current price and price keeps going up. I'm not sure I sent this as a PDF file, but let's hope. So the buying stop is the order placed above current price and price keep going up. This is what it means. Buy stop. This is the buy stop. It's placed above the current price. So let's say now, this market is, the current price of this market is 89116.31. You understand? 0.21, 0.17, 0.20. That's the current market. You see the green line and the red line that is moving up and down. That is the current price of the market. You understand? So now they said buy stop is the order placed above the current price and price keep going up. So what it means is, I'm talking about buy stop here. This is buy stop. It's placed above. This is above. If it's like this now, this is sell stop, is below. But this one is above. You understand? So it's the order placed above current price and price keep going up. So now I'm expecting that this price is going to come to 89157.21 here as a buy stop order. You understand? So it's the order placed above the current price and price keep going up. And when you talk about the sell stop, this is what they mean about sell stop. It's already opposite. It's below the current price and price keep going down. So my sell stop is here. I'm coming. This is my sell stop. And I can even activate it like this. Are you getting me? This is my sell stop. So I'm expecting that this market should come to this place. I said a buying stop is placed above, but a sell stop is placed below current price and price keep going down. So moving on to limit order. I said we have pending order, and under the pending order we have the stop order and the limit order. So we talked about the buy stop and the sell stop. So now we are talking about the buy limit and sell limit. So buy limit is the order placed below price and price keep going up. Let's say this market has moved far now. You understand? This market has moved far and I don't want to buy the market at a very, very expensive rate because of my stop loss. You understand? So the buy limit is the order placed below price and price keep going up. This is simply what they mean. Buy limit is the order placed below current price. You understand? And price keep going up. You don't need to confuse yourself with that. Now what they mean is that I'm waiting for this market at 89113.41 to touch it. So once it touches, then it should now continue buying. You understand? That is the limit order for buying limit. I'm expecting this market to come to this point 2, to this 89113.41 to touch it and just start moving. And when we are talking about sell limit as well, sell limit, this is sell limit. You see, sell limit is the order placed above price and price keep going down. So if now I'm expecting this market to sell, are you getting me? If I'm expecting this market to sell now, this is going to be it. I'm going to place my sell limit above. So I'm expecting this market now to touch this my line and just come down. Are you getting it like that? So moving on to analysis methodologies. um Technical analysis, no, I think I explained this already. I explained this in the group. You can read from the note I sent this morning. So let's move to time frame. Time frame is also what I wanted to show us. It's what I want to show us on this in this video. So time frame refers to the period that each candle forms. So now if you notice, you see I made mention of M1 yesterday, M5. This is the 5 minute chart. From the 5 minute chart, 15 minutes, you see. So what they mean is like time frame refers to the period that each candlestick bar or tick represent on a trading chart. Let me zoom out. Okay. So this, each candle you see here, each and every candle you see here is this red candle you see here, this one, this one, this one, this one. Everything spent, this candle spent 15 minutes to form. This other one spent 15 minutes. This one spent 15 minutes, 15 minutes, 15 minutes, 15 minutes, 15 minutes. Each candle, each candle you see here, they spend 15 minutes to form. And if I move back to, let's say I move back to H1, you see each candle here, all these ones, they spend 1 hour to form. Same thing applicable. Let's say I move to daily. You see each candle here, 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 they spent a day to form. So this is day 1, 2, 3, 4, 5, 6, 7, 8, 9. From this I'm coming, let me get a tool to analyze what I just did. You see this place I marked out. Let's mark out here. This is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. This particular square now has 11 days of candle inside. 11 days. 11 days. Are you getting me? 11 days of candle being formed. And if you are going to go to the week, you see there is a week candle inside, a whole week candle, 1 week. And I can easily just zoom it out again. You see each candle you see on this particular time frame now, spent a week to form. They spent a whole week to form. Are you getting it? So if you have any question, you can always switch to the number. I think the admin number on the Telegram, you can always reach out to him, because I want everybody to understand perfectly what you are doing there. So that is that about that. So here also, each candle here forms like they spent 5 minutes each to form. Each candle here, they spend 5 minutes each to form. So it defines how price data is visualized and determines the scope of market analysis. We already know that this market is coming down. When the market is coming down like this, it's a selling market. This one is selling here. I'm coming. Let me get a tool to just analyze some certain things. This market is going up. You see, this you can see my line here. This market now went up. So let's say this is gone again. Then year to year, you see this market sold here. You don't need to really complicate yourself. We're going to get to everything. It's not hard. It's not hard. I just want us to take it easy on each other. You understand me? So moving on. So we have divisions of time frame. We have the lower time frame, the intermediate, and the higher time frame. I will mention that the lower time frame represents shorter period of market activity, which means we're talking about the M1, which is this 1 minute chart. You understand? We are talking about the M1. So each candle here spent 1 minute each to form. You see, it's even counting. You can see this spread, this green line and this red line that is jumping up and down. You see, 0.41 seconds left to complete. You understand? So this is the lower time frame, the M1, the M5. This is the M5 chart, and the and the M15. You understand? So they are simple as this. And we said the lower time frame are used for scalping. You understand? They are used for scalping. But we're going to get into everything as we move on this lecture. So the intermediate time frame covers moderate durations. Here we have the M30. I'm coming. We have the 30 minutes. We have the 30 minutes. You see, this is jump 10. Jump 10 is the asset I'm on right now. Jump 10 is the asset I'm on right now. So you can see M30 beside. So we have the M30, we have the H1, and we have the H4. But for some people, they always categorize 30 minutes only as the intermediate time frame. But H1 is also still a very good time frame for intermediate. You understand? So, and for the higher time frame, and sorry, we said the intermediate time frame is used for identifying trade setup. You know, so the higher time frame, they respect longer period. Once you hear higher, because we've talked about 4 hours as even being an intermediate. So once you hear higher time frame, we are talking about something that is, that is far ahead. So we're talking about the daily, we're talking about the weekly. I don't know if you get it. This is the day one. Each candle here spent a day to form. So we're talking about the daily. We're talking about the week. This is 1 week. Each candle here spent 1 week. 1 week to form. Then this is monthly, MN. So I hope this is understood. You understand me? So we talked about trading psychology. I already sent a note on trading psychology, and I talked about the type of traders as well, because I don't want this video to be as long as complicating, you know. So, and I said our next topic will be on the trend line, which will be shown on this chart. So let me just make that quick. This is a trend line. You see this red line here? This one I deleted is a trend line. This is also a trend line. This is a trend line, all these lines, they are lines, they are trend lines. You see? This one is a trend line. This is a trend line as well. This is a trend line. This is also what it is. This is a trend line. Oh, I've changed this into bar. But this is a trend line anyway. Let me change this back. So that's a trend line. What other things? I'm coming. Let me change this thing to my candlestick bar. So this is a trend line. All these things are, they're all lines. So it's nothing complicating, but let's just move easy. You understand? Slow and steady wins the race. And in the next topic, we'll be talking about the trend line features, the rules for trend line, the guidelines, talking about the support, the resistance. Maybe we'll jump into price action, jump into price patterns, chart patterns, and all. But for now, we are good to go. And that was all for today. Thank you all.